Hello, everybody, and welcome to OAG's latest webinar. Good afternoon from the UK and good morning to those of you listening across the Atlantic. Today, we're going to be talking about routes and revenue and the path to profitability, and we'll explore the topic in a little more detail shortly. But before I do that, I'm going to introduce our speaking panel today. I'm joined by John Grant, as ever. Welcome, John, OAG's Chief Analyst, full of insights and opinions, I'm sure, this afternoon, having had a day to
Good to be back. Last one this summer. Yes. So change of seasons on Sunday. It's the quiet period. That's 6 weeks before sort of Christmas, apart from the US, of course, with Thanksgiving and their seasonal holiday before everyone else. Lucky people.
I think summer's well and truly over where I am. Autumn is definitely here. Car window scraping and chilly mornings have set in. So, but we can't complain. Talking of the US, we're delighted to be joined by Hayley Berg. Welcome, Hayley. Hayley's the chief economist at Hopper. And in that role, she leads the research into Hopper's databases of travel data. Really that's about uncovering trends and insights that help the end user get the best deals. For those of you who don't know, Hopper is a global travel platform that powers Hopper's mobile app and also HTS partners' direct channels. Hayley, welcome.
Thanks for having me. I'm an avid user of OAG's data, so I'm excited to talk about it from our side and from your side.
Oh, great. You're in good company. I love data, don't we? Okay, so well, let's dive in. We basically, the topic, as I said, was routes and revenue, the path to profitability. And we've sort of set out some areas that we want to look at. But this really, the topic came out of a sense that we've had for some time now in the industry where we all knew that 2022 we were going to see a big surge in travel as a result of countries reopening, and most of the North America, European markets, Latin America, parts of Africa didn't ever close, parts of Central America didn't ever close, but most of these markets reopened in 2022 in earnest. And we had this big surge in demand, lots of travel, lots of headaches associated with that. But then what became clear as we went through 2022 was the beginnings of economic crises in different countries, rising inflation, rising interest rates, and across Europe and North America, that led to increased costs, both in energy and the price you pay for groceries in the supermarket. And generally, disposable incomes have been compressed by all of those price increases. And I think from our perspective, we had this sense that at some point, the pressure that's putting onto fares and the pressure that's putting onto people's disposable income for travel, the bubble's going to burst at some point. So I think what's really interesting is here we are a year on from that point, and I think it probably was around this time last year that we started really worrying about what the winter was going to bring, not only in terms of our own energy bills, but what the industry would really look like. So let's explore that in a bit of depth. That's a bit of context, I think, about why we wanted to look at this subject, and not least because we like looking at data and we like talking about what's happening in the industry. So we'll dive right in, and please don't hesitate to ask us questions as you go. I can see John's already on the chat with the audience, helping to share some information there. So, but yeah, feel free to ask away, and we'll do our best to deal with those as they come up. So those of you who are regular listeners will, watchers as well, will know that the slide that we're showing right now is one that we we've used fairly consistently, and it's the kind of big picture, what's happening in capacity terms for the previous months that we're looking at. And we're sort of still holding on to that 2019 benchmark comparison. Like we said last year, we're done with 2019, we're going to move on. We haven't quite done that yet. And I think for as long as there's still a gap between 2019 and where we are, then we'll probably hold on to it for a little bit longer. But let's be ambitious and hope that 2024 is the year that we start comparing just year on year. So in capacity terms, this looks not too bad. 1.6% below globally in October, and actually tracking for a little bit of improvement through the rest of this year. And when we look into quarter one of 2024, there looks to be a little bit of an uplift. Now, that might be a bit optimistic, and it's easy at the beginning of a season, isn't it? We're not quite there yet, but it's easy at the beginning to have optimism about how the schedule's going to pan out. But not a bad place to be, John, given where the industry's been.
Yeah, no, it's not bad. But it's nowhere near that orange line, which is what would normally be the growth pattern for the industry if you applied 4 years cumulative growth on the 2019 point. But yeah, it's coming back. I think we're going to, throughout the winter season, so until at least the end of March, probably stumble along at between 2 and 3 percentage points less capacity than there was in 2019. A whole host of issues to that. I think in the first quarter of next year, talking to some airlines recently, they're still uncertain about both what demand is looking like, but more importantly, what resources they're going to have available to actually operate. And not so much in the very large airlines, but in the small to medium-sized carriers who, provide important lifeline connectivity to their communities. Pilot shortages are a real issue, particularly in North America, and they're concerned about losing their staff to the larger organisations, and of course all the investment costs that they've taken, they get no or little return on. So that's frustrating. I think the other big issue or the big challenge, the unknown that we have, remains around the Chinese market recovery, and particularly the transition back from what became a domestic market to a domestic stroke international market with the same levels of volume in the international arena. We'll touch on that in a minute, but it's a bit of a concern. I mean, to Hayley's point, and some of the stuff we're seeing, is the US domestic market beginning to go a little bit soft over the next couple of months? Are they further ahead in their recovery, that the revenge spend has finished, and people are a bit more conscious about disposable income and what money they've got left in their pockets? It's a fascinating situation where so many events are continuing to impact the industry, not least, of course, political issues around the world.
Yeah, we're really struggling to see North American recovery on Trans-Pacific in particular. And, though domestic has come back, domestic within the US has come back to about 2019 levels on particular weekends, Thanksgiving, Memorial Day weekend, bank holiday weekends. We see sometimes 10% more capacity than 2019. On the whole, we've stagnated in the domestic market right at 2019 levels. And that stagnation has only come because airlines are flying larger jets fewer times. So it is a much different market in terms of how many planes are departing, how many seats are on each plane in the domestic market than it was in 2019, even though those lines may look very similar. And it's a strategic position, in my opinion, that the airlines are not bringing back more slots than they need in the event that there is a real slowdown. And, they don't have to redo all of that optimization that they've done in the last 3 years to try to figure out how we can operate with fewer pilots, fewer employees, and so on. So I think they're well positioned if weakness appears early in next year. But that's kind of the ultimate question, is when will we see the weakness? Because we haven't yet. We've been waiting for it for so long, and it's not yet materialized.
Yeah, I think that's the $64,000 question, isn't it? That has that, and I suppose it sort of made me ask the question about the relationship between pricing and demand. You know, how has that changed as we've seen people navigate through, you know, certainly from my perspective, over here in the UK, almost unheard of levels of interest rates rises and inflation, similar, you know, similar issues in North America. So it's really interesting to see that people are still prioritizing travel. And there's a question there, isn't there, about to what extent is travel actually an essential item, no longer a luxury item. And I think we're seeing, you know, I think we've sort of conceived so far, haven't we, of the post-pandemic period being revenge travel and revenge spend. But we're sort of beyond that now in markets where we're more than a year into recovery. And maybe what we're seeing is actually a shift in pattern and a shift in behavior that's probably been triggered by the pandemic in terms of how people choose to live and how they prioritize travel. But I think we certainly are seeing that, aren't we? Certainly in some markets.
I think that's certainly the case in Europe. You know, there are lots of people, sadly, who were saving for their first homes and suddenly have seen the cost of mortgages increase exponentially and essentially wipe them out of the opportunity to purchase. And on that basis have sort of said, I'll take a holiday. I'll use it to do something, you know, rather than buy a fridge because I haven't got a house for the fridge. You know? It's quite simple, really, isn't it? And there's no doubt that's had some impact in Europe, certainly in the UK and Northern Europe. You know, the weather during the summer wasn't particularly wonderful. So some travel companies have reported stronger demand into the first couple of weeks of the winter season for the Canaries and the Greek islands that previously wasn't there, because there's a chance to get away and get a bit of sun at some pretty cheap prices at this moment in time. So it's it's a changing market, certainly. And Hayley, you've not seen any huge return of corporate demand, have you, in the US? It's still the great where is it type question.
We hear, so Hopper itself, we're primarily a leisure app, but we hear from the US airlines different stories. Some say, you know, corporate contracted is 100% back. Others say we're getting rid of business class, we're filling it with premium economy because we're not booking corporate as much. So that leisure corporate split is definitely changing in the US. But what I think is interesting is some of this is definitely post-pandemic change in behavior. But I do think a lot of this shift towards spending discretionary income on travel is generational. Because even pre-pandemic, 2019, the big story was millennials are delaying milestones. They're not buying that house. They're not having children as early. So they're taking these bucket list trips. And we're now almost 5 years on from them. Gen Z, you know, more than half of them are over 18. A lot of them have jobs. They're building wealth. Millennials are now into their 40s. They've built wealth. And these two generations consistently prioritize spending on travel more than older generations did at this age. So I think some of this is also, we kind of fast forwarded 5 years overnight, it feels sometimes, with the pandemic. And now these generations are older, they have more money, they're taking on more responsibility in the workforce, and they are the ones who are willing to fly basic economy so they can stay at a 5-star hotel, willing to kind of do that math to fit their ideal trip into whatever budget they have, even if it is being shrunk by inflation, wage stagnation, and so on.
And that's a real shift, isn't it? Which I think is, you know, we sometimes get sucked a little bit into thinking about aging populations and the impact that that's going to have on travel and people's willingness to you know, the sort of spend the kids' inheritance type of traveller. Not putting you in that category, John, at all.
Well, I'm all up for spend. I'm all
You've
up for
done it.
spend.
Yeah,
Absolutely.
you've done it. You've done all those bucket list
Yeah,
trips.
you know,
But you know, it's really interesting, isn't it? Because actually, if we've got that generational shift happening in terms of how people feel about travel, then that sort of makes a difference in our thinking about the longer term, doesn't it? I feel like I must move us on a couple of slides at least, because we're going to be here still talking about this, because we could talk about this all afternoon, I think. Let me just go back to the deck for a minute. And I want to just have us take a little bit of a look. Oh, I've gone far too far forward. Sorry about that. I want to take a very quick look. We talked about China briefly, and it's worth noting for anyone who wants more of an insight into some of the stuff that we're going to go over pretty quickly. We ran a webinar this morning where we covered some of these issues in more depth, and you can access that through OAG's website, a recording of the conversation this morning. I think the point here and what sort of resonated with me was there are sort of changes happening here too. We talked about China domestic being, you know, strong and recovered, but actually the international market is still not experiencing that surge that perhaps everybody anticipated. And the Chinese outbound market is massively significant, not just for the closer markets in the rest of Asia, Australia, Southeast Asia, but also to destinations in Europe and North America who previously welcomed significant volumes of outbound Chinese travellers. I think what's interesting is we certainly saw, when we look back, and this is just a quick look at how capacity was operated by the carrier's country of residence. And we've just separated it into Chinese carriers and foreign carriers. What we saw between 2019 and 2023 was a shift in just slightly over half of capacity was operated by Chinese carriers then. Now that's gone up to 58%. But that masks a little bit of a story, or a different story, I guess, if you look at the regional breakdown of that. Clearly, places like the Southwest Pacific, which is Australia mostly, is a significant market for Chinese carriers. But you've got real shifts in terms of the dynamics or the composition of operators on markets like Europe and North America, which is being driven by other things. You know, it's being driven by
this is all politics, isn't it?
Yeah.
You know,
yeah.
All three of the big events are politically inspired. Australia's recovery in traffic in capacity is because, you know, the Australians and the Chinese have agreed to disagree, but begin to work again with each other because they need to. The US-China relationship is still quite tense, and during the pandemic we saw a big reduction in permitted capacity between the two countries. That's come back just a little bit in September and October, but you know, we're talking 30 flights a week compared to 200 pre-pandemic, and amongst the US carriers, no real appetite to do anything more than a once daily service to Beijing and Shanghai at the moment. And whilst that's the position, you can't see any of those tier 2 Chinese airlines and cities being reconnected to the US West Coast. And then, of course, you've got the added complexity of the closure of Russian airspace for US and European airlines, which has extended sector lengths, 15 hours to come from, you know, Northeast Asia over the North Pole back to Europe. That's heavy in terms of crew and also operating cost. So we've come to a situation where when the Chinese airlines are rebuilding out, you know, we're seeing them go back to destinations, so they're reconnecting. What they're not doing is operating with the same degree of frequency as they previously did. So where it was, you know, daily, it's maybe 5 or 4 a week. And we're not seeing them using smaller aircraft types, and the A380s eventually going to be retired out of the few Chinese carriers that have the aircraft in their fleets at the moment. So it's a very different market that we will see as it recovers further. And then you've got, just a reluctance of Chinese nationals to travel again. Maybe they feel threatened, maybe they feel uncomfortable with the thought of traveling overseas. Thailand tourism expected 5 million Chinese visitors by the end of the year. That's been reassessed down to 4 million. And when they spend hundreds of dollars on each trip, that's a big impact in the Thai economy.
And geography it's a big feature, isn't it? We've sort of said that throughout, that the big domestic markets, the US, China, have had the benefit of being able to facilitate domestic tourism. And there's a risk, isn't there, particularly for the Chinese outbound traveller, that process of travelling domestically in China and enjoying holidays at home, but 1,000 miles away from home, it becomes the norm. It continues. Although interestingly, in the States, it seems to have had the opposite effect, and is pushing people into traveling to Europe and other.
But but the strength of Hayley will know better than we do.
Yeah.
The US dollar relative to the euro and pound. I mean, it's just too cheap a proposition to miss at the moment, isn't it? To come to Europe and go to McDonald's rather than go to your high street McDonald's.
Absolutely. Europe is so front and center in American travelers' minds. Asia is as well, mostly destinations in Japan. I'd say those are biggest in South Korea. But Europe has always been really the number one destination region. And what's interesting is this summer, Americans paid the most that they've paid in at least 5 years to go on these trips to Europe. So even when it's expensive and crowded and hot, it's still being prioritized. The media cycle in the US has joked most of this year that everyone knows someone who's in Italy right now. And for many of us, it's true. And it's because there is just this incredible focus on taking these big bucket list vacations. And our hypothesis is that this summer is really been the first fully open, no COVID restriction summer. It wasn't until June of last year that you didn't have to have a negative test to re-enter the US, which means all those trips that would have been planned in April and May for Europe didn't get planned until June and July, so they were shifted. So this is our first full summer, and travelers paid $1,400 to go to Rome. They paid $1,600 to go to Athens, and we see them continuing to spend that much, even as prices come down, thankfully, on international routes. But what's coming next for American travelers is more regional trips. That's what we see typically at Thanksgiving, which will be the third week of November, and at the holidays as well. So we had a big summer, but everything's going to come back a lot more domestic, Caribbean, Mexico, Central America.
And even we've had a question about what is the impact of some of the events that are happening in the Middle East at the moment. Well, the IATA says it's not significant. United Airlines would say losing $738 million, which is their estimate of lost revenues, quite significant. But in broad terms, it is a neutral impact. But some of the US carriers are looking to reallocate that capacity into Europe for the winter, which is unheard of. But they've got nowhere else to go. They don't want to use it in Asia. There's no need for it in Asia at this moment in time. It doesn't need to run down to Mexico because that's a frequency market. That's not where it's required. And so suddenly you've got destinations in Europe, maybe places like Barcelona, for instance, that were quite seasonal, have the potential to at least experiment with year-round frequency, albeit slightly lower than what they would have seen in June and July. So it's a really interesting change of dynamics, and airlines are moving quickly to change with the way the world looks.
I think just to come back to the slide deck again for a moment, and I've skipped forward a little bit just in the interests of time. We were joined this morning on the webinar by Paulos Lacko from IATA, who's their head of industry analysis, and he shared some slides with us this morning. in the deck that they were happy for us to use this afternoon. And I think I just wanted to show this one in particular because it kind of picks up on that point that you were making, Hayley. So just to decode what you're seeing here. On the top, you've got O&D passengers for quarter two 2023 versus quarter two 19. And what IATA have begun to do is break down their analysis into distance to see actually what are the characteristics and what are happening, what's actually happening in terms of demand in those journey distances. There's actually a slide before which goes into a bit more detail on that, which if you want to listen back to the morning webinar, you'll hear more about. The point I sort of wanted to make here is, so there's the O&D passenger comparison, which shows for these key three regions, actually how these markets have recovered versus 2019. And then in revenue terms, what the picture is. And it absolutely supports that point that you were just making, Hayley, about what people are prepared to pay to travel on those sorts of distances in that medium to long haul market. You know, that's really clearly what is happening and what's being seen there. So it's always nice when the data kind of stacks up with with what we think is actually happening in the market. So let's move on to the next slide, and this again just kind of picks up on what you were saying, Hayley, that actually what's interesting to me is that clearly, the strength of Florida continues. It's ongoing, isn't it? And having been there myself, I can understand the attraction. And VFR markets, I guess, are important too. We're seeing that certainly in what you're reporting here.
Yeah, Florida definitely came out of the pandemic incredibly strong. Being a primarily warm weather outdoor destination gave it some edge during the pandemic. But it has the really strong allure, especially for international travelers, of warm weather and Disney. Warm weather and a lot of cruises pick up from Port of Orlando. So corporate events, Orlando has an incredible amount of conference space. So it has a little bit of everything. So it's something that feels ever so popular. We have seen the rise again of the more standard domestic cities, New York City, Chicago, Las Vegas, LA. They're back at the top of the rankings when we look outside of just the Hopper universe. But among our users, which are primarily Gen Z and millennial, very much warm weather vacation destinations, trying to book as inexpensive of a trip as possible. And we see that in the international destinations as well. Puerto Rico is incredibly affordable from a lot of US cities. It's a shorter flight. You can do it in a weekend. You can do it in a week. And it's always been incredibly strong. Puerto Rico, Cancun. So those will always be the most searched among our demo. But then I think number 5 is even LA to Tokyo. So there is still, this demand for those longer haul trips. They're just fewer and further between.
It's interesting, isn't it? Because you see all of this demand, and yet in the height of the summer, the US FAA was saying we can't accommodate any more air traffic into Florida. It's completely full, and we just can't soak any more up. You hear the same thing in the New York airspace where, literally there just is not enough space, and every flight's like a gamble as to whether it's going to operate or get cancelled because of those constraints. Mm-hmm. And it's that constant disconnect we see between the industry's supporting infrastructure and the demand, and we never seem to get it right in the right places at the right times. And coming out of a pandemic, I think it would be really difficult to predict where it was going, but it's fascinating to see how strongly some of these places have come back.
Yeah, and the constraints from the FAA air traffic control, it's really a challenge in the US, and we've made incredible strides in the last 18 months, but the disruption rates remain super elevated. I think this summer, on average, 1 in 4 flights was disrupted, so canceled or delayed. And oftentimes these delays are just 15, 20 minutes, but a good proportion of the time they're also an hour, 2 hours, 3 hours.
Yeah.
And what's different is, the pie is smaller. There are fewer flights departing, but the percent of those flights being disrupted is larger. So even if it was the same percent disruption rate as we saw in 2019, more people would be disrupted.
Yeah.
So there is, a very palpable frustration from American travelers that, I book a trip and I'm not actually sure if I'll get to my destination, if I'll have to book a surprise hotel room on the way. And we've seen that anxiety come through in what travelers are prioritizing in terms of spending. So we launched back in 2021, serendipitously, a disruption protection product, a flight disruption guarantee product, where essentially if you're disrupted, we give you the value of your ticket in the Hopper app. You can go book whatever flight is available and get onto your destination, kind of cut the middleman out of it, just get you wherever you need to be without having to buy a ticket out of pocket. And 1 in 5 flight bookers on Hopper are buying this product. They might buy the cheapest ticket available, and then they spend an incremental 10% to add this product. And, the NPS and the CSAT on the product are insane. 85% CSAT, NPS over 70, because there is so much anxiety about being disrupted. And that anxiety is being matched by actual disruption rates that are incredible. Christmas last year was probably one of the biggest meltdowns.
Southwest meltdown. Yeah.
Southwest meltdown, but then a blizzard. And 2 weeks prior, there had been other technical malfunctions at airports. So it was a tsunami of disrupted passengers, and no one knew what to do.
And the supreme irony in all of this is that, the US Department of Transport is now mandating or about to mandate delay compensation from airlines in a formalized structure. And the reason they're doing that is because they actually haven't got their infrastructure in place that allows the airlines to operate to the schedules they want to operate. It's just, supremely ironic that one part of the administration is saying need to put this in effect, and another part is actually the cause of what's happened. I mean, we see it in Europe as well. It's not.
I think there's so much in that, though, isn't there, in terms of, fixing the infrastructure is a long-term issue, and it's costly. So fares are only going to go one way because airline costs are only going to go one way in terms of addressing investment in infrastructure that's needed. So it's even more sort of ironic to me that actually when we talk about things like unbundling fares and giving customers more choice, and we've got a slide later on to talk about ancillary revenues, which is essentially everything beyond the sort of base ticket price. It's really interesting that that's where people are prioritizing spend and choosing it. Because when I think of, the steps that low-cost carriers in particular have shaped the market, haven't they, in terms of allowing people to choose what's important to them. And there's a whole sort of mindset, isn't there, about actually if what you're asking, or if what people are choosing to spend money on is something that attempts to mitigate the impact of disruption, then there's a whole big problem, isn't there, in terms of how the industry's operating. Because it's really not about offering people, I suppose you could say it is important to them, but I don't think that's what airlines are envisaging when they're saying, we're going to unbundle fares and be competitive and generate extra revenue. It's not at all, So it's something that I guess is evolved because of the circumstances and the situation that we find ourselves in. My sort of complaint, I guess, about unbundling is where do we draw the line with it while we're on the subject? Have we seen so-called legacy airlines go too far in terms of unbundling their product offering to consumers, so that, you know, when you book a transatlantic fare, and we were just talking about that before we went live today, when you book a transatlantic ticket, what's your expectation about what's included in that? Do you expect to have your seat allocated for free as part of that, or do you have to pay more for that? And the answer is generally now you have to pay more for that. Do you expect that you'll have a checked-in bag included in that ticket price? Probably not anymore. You have to pay for that. And, you know, is that a model that really works for what people actually want in terms of, you know, in terms of travel? I guess in the context of your short break to, you know, to Puerto Rico or to Cancun, of course it does. Yeah, of course it does, because you just take your carry-on on the plane. But I think it's really interesting that we're seeing this kind of segmentation happening because airlines are trying to generate revenue and compete. But what is that doing to passenger behaviour? And is there a segment of the market that actually just wants inclusive pricing, or all-inclusive pricing? So many questions in there.
It's interesting because in one way, unbundling, you know, look at 2019. Unbundling was incredible for international travel from the US in 2019. You could take a round trip flight to London for under $300. And, you know, it would be basic economy and you probably couldn't pick your seat, but you could bring a bag, you know, a bag on, some hand luggage. And that made accessible travel that previously wouldn't be accessible to some travelers. And now where we are post-pandemic, you know, prices on the whole in the domestic market are lower for US travelers this year than they were last year, but on international markets, they're still much more expensive. So without low-cost carriers on transatlantic routes, we're missing some of the lowest prices. So those fares are now, you know, more expensive on the whole. So it might mean that travelers can only access those trips by sacrificing a lot of ancillaries. But what's interesting is it begs the question of should consumers be allowed to build their perfect fare and decide for themselves if that's what they want to spend on. And I come back to what we see on the Hopper app. So we sell, you know, the range of cabin classes, traditional ancillaries like extra bags, seats, but then we sell our own suite of fintech ancillaries that address things like disruption, flexibility, even locking in prices for short periods of time to address price anxiety. And what we see is travelers book on the whole as cheap of a base fare as they can. And then they spend either on these traditional ancillaries or on these newer fintech ancillaries we've introduced. And on the whole, they're picking these fintech ancillaries that address completely different things. It's not bags and seats. It's, I want to be able to cancel this flight and get the whole value of the ticket back, no questions asked. I want to be able to change my dates and potentially even the carrier I'm flying to suit my schedule without having to worry about not getting my money back. So in a way, it's almost a better reality where our consumers can pick and choose what they want, but it's only a better reality when there are still deals available for people who want a traditional experience and an all-inclusive ticket. And I think that's where the challenge is on some of these international routes that are just so expensive that the ticket prices on the whole suite of ancillaries are pretty incredibly high.
But the original, you know, when you go back to what NDC was really about and what they were trying to do, it was essentially for the airlines about unbundling their product. It wasn't about people like Hopper creating fintech product that they sold around it. And so you guys have done really well, and congratulations on that. And the airlines themselves are probably looking around thinking, actually, it wasn't a great success that we wanted it to be. And, you know, for every person that likes NDC and ancillary revenues and all of those sort of the unbundled package, there's 2 or 3 typically located just north of Edinburgh in Scotland who you know, are unhappy with the way things have progressed. And it you know, it's a big industry, billions of people flying every year. You will never satisfy more than 5 or 10% of the people by either the fare or what's going on. So it's a fascinating dynamic. The only way to solve it, Deirdre, is earn enough money to have your own private jet.
Well, yeah, exactly.
It's sorted.
It's never going to happen, is it? And I feel I should say, actually, as someone who has had more than one flight cancelled on me at very short notice in the last 12 months, actually the idea that I could, I could have had some compensation for that, or protection. That would be probably something that would be in the mix in terms of my travel decisions. Okay, let's flick back to the deck. We're kind of skipping around here, but that's okay, because I think that's just where the conversation is taking us. You mentioned, Hayley, that actually domestic airfares in the US are down from a high in 2022, and I think that's interesting, and I guess sort of takes us into that question about, do we think that's because demand is softening? What's going on there? And I guess that's the other sort of $64,000 question, isn't it? Reading behind the numbers, why do you think that's happening?
Yeah, the simple explanation would be softening demand. But when we try to find hard data points or even qualitative data points from our users, from omnibus surveys, we struggle to find any hard data that says this is demand softening. What we see instead is a few things. One is capacity on domestic is back to 2019 levels, and international opened up in a big way this year. So a lot of travelers who last year helped drive that bubble in domestic airfare are taking international trips this year. Mm-hmm. So they're not traveling, they're taking a longer haul trip, or they're instead of taking 2 domestic trips, taking 1 domestic, 1 international. So there's a shift there. There's also, in the supply mix, a lot of low-cost carriers took advantage of 2021. I think about the New York area, for example. There is an airport on Long Island, Islip, where Breeze Airways have added direct flights to Florida. So if you look at New York area flights to Miami, to Orlando, there are flights for $50, for $90 round trip on this low-cost carrier. So there was a lot of movement, and low-cost carriers expanded quietly in 2021 in particular, and then 2022. So there are lower fares available. But something that I think perpetuates the kind of myth in the US media that domestic airfare is very expensive right now, we hear that all the time, is travel behavior changed, and travelers are booking so much more last minute now that oftentimes they're missing out on the lowest prices available. So though when I look at all of the prices available on a given day, I see, the average domestic fare, I think, right now it's around $280 per ticket. That is, the weighted average, demand weighted average fare. But if I'm looking at a ticket for Thanksgiving, which is now in less than a month, I'm not seeing an average of $280. I'm seeing much more expensive than that because I'm looking too late. I'm missing out on the lowest price. So on the whole, we have yet to find any compelling statistics that tell us demand is softening. TSA numbers still look great. But I think rather what we're seeing is some normalization, some increased competition from low-cost carriers on major routes.
And that just shows how sensitive the supply and demand balance is, doesn't it? When you see something like this happen, which is, in the overall scheme of things, a few percentage points more capacity returning, then suddenly the distortion it has on the fares is quite considerable, particularly when it's low-cost capacity that's coming in and it's serving point-to-point markets rather than an international to a domestic connection. So I think it's fascinating that for many years the consolidated big 3 carriers plus Southwest had a grip on many of the domestic markets, and they're now being challenged not just by Breeze, but you've got Spirit, who've put a lot more capacity in, and you've got Allegiant and Frontier, who are much better at adding capacity for the holiday seasons and really stoking up the demand and reducing the fares. So I think you're right. It is more about supply and demand. But then the worry is that, we're talking now about the top of the industry's profitability cycle. And this is an industry that, has a lot of vulnerability, and it does go in a cyclical fashion. And we will, I think, I've said before, I think the US domestic market and the US carriers are probably at about midnight in terms of their profitability ratios, and they're going to fall over the other side in the next year, 18 months. And it's going to become a tougher market for those guys. Whereas in Europe, we're probably just a few minutes before midnight, and we've got a bit more strength in the market that will see us through. But it's all going to tip, and it's too much capacity coming back too quickly. In some ways, the Pratt & Whitney engine issue, which we may look at later, 250 grounded aircraft at the moment on average around the world, it's a bit of a blessing in disguise, because that's 160,000 seats that are not in the market.
John, that's one way to turn a negative into a positive.
Well, I'm sure Pratt & Whitney are spinning that way, because
let me put that slide up right now.
Whitney will want to say, well, guys, this is positive. Michael O'Leary in Dublin is thinking, this is positive. I'm going to sue you for whatever I can at this moment in time, and I'm going to be able to control capacity a bit more, which means I might get a few more dollars a fare. So it's strange how this industry works sometimes.
Yeah, I think it's we're perceiving of this as a headache, aren't we? But you've just spun it in a whole new light. So
well, I genuinely think, if you look at Ryanair, for instance, who said, we've had to cut a number of aircraft and routes. For the people who had bookings, etc., it's more than a bit of a problem. It's a very large problem. But beyond that, you've got to think from the airline perspective. Maybe that's not a bad thing. And of course, they don't need to resource those aircraft at the moment. 250 aircraft down a week. You've got to be talking about 1,500 pilots, 1,600 pilots that would have been required to operate those aircraft.
Yeah, it's a challenge, isn't it? Let me we've gone all over right now in our slide deck, but given that someone's just asked about headwinds and tailwinds in the US airline industry today, we do have a slide that actually is just more generally about headwinds this winter, and the Pratt & Whitney issue is but one of those. We took a look at, Vision of Humanity produced a Global Peace Index, which we thought was just an interesting visual representation of where the state of peace is very green, and where there is considerable unrest or war or significant disruption is red. And that sort of visually really shows us how challenging for global airlines, and I include the US airlines in that, given the range of their networks. But it shows just how challenging it is for airlines trying to navigate not just things like pilot resources, economic challenges, but also the geopolitical issues that are happening that will just continue to impact on both demand to travel to certain parts of the world, but have an impact in terms of rerouting and travel around those places where airspace isn't open, for example.
Yeah, very, very challenging. I mean, from the US, if you want to, as we've been saying right at the beginning, if you want to get to Northeast Asia, then avoiding Russian airspace is difficult. If you look at Flight Radar and other such products, and you look at the map, you can literally see a trail of aircraft all following the same routing through a very tight piece of airspace as they route through, and coming very strangely coming westbound from Northeast Asia to Europe, you actually go eastbound because you track out over the North Pole and come down the other side. That's a 15-hour flight. That's a 4-man heavy flight deck crew. 4 hours of extra fuel burn. The challenges are immense at the moment, and those headwinds are not going to go away. And ironically, we're talking about headwinds, but we know in the winter season, you can add another 20 or 30 minutes onto a transatlantic block time because of the prevailing wind currents. That's another 20, 30 minutes of fuel burn that someone's got to factor into their cost.
I guess that's the other issue. We heard this morning, didn't we, from IATA, that their view is that yes, there's the challenges caused by geopolitical issues around the world, but that is going to impact on oil prices too, which will then, it further exacerbate the situation. And whilst I was at a event recently, a few weeks ago, and heard from some airline CEOs about how demand is holding up, demand is strong, and how they could cope with a degree of oil price increase. There's a ceiling to that, isn't there? And there's a sort of pending challenge there, I think, for carriers in terms of managing profitability.
But what airline CEO is not going to speak in a public forum and tell you that he can manage and all of those sort of things? If he didn't, then he wouldn't be the airline CEO the next day. So they're going to have to spin it that way. And they do have some slack, and they do have some flexibility in what they can do. And many of them are hedged against fuel, and many of them, particularly in Haley's market, are earning the majority of their revenues in US dollars, and the industry prices and all its costs are generally in dollars. So, US airlines are well placed. But I think it's fascinating to see how suddenly we're beginning in Europe, and it will have an impact in the US undoubtedly, because someone will make some money out of this. We're beginning to see some European consolidation and more thought about consolidation. SAS looking as though their latest investor is KLM Air France, TAP Air Portugal coming up for privatisation. And guess what? They were profitable in the last quarter. Now there's a surprise, because you can only sell a profitable airline. But they have a niche in the Europe-Brazil market that's quite extraordinary and gives them some advantages that they can play. Maybe Europe is going to consolidate in the next 5 or 10 years. We'll end up with 3 legacy groups, and we'll end up with 3 low-cost airline groups, maybe 2 low-cost airline groups. Been rumours before about Wizz and EasyJet. Whether there's anything to that, we'll find out in the course of time.
Does that offer the consumer the best choice and the most competition? That's something that's going to be interesting.
But what does the consumer want, Haley? What does the consumer want? Do they want the best price, or do they want the best service levels? And from what you're saying, a lot of them trade down to the best price, and service product quality comes very secondary or even last in their listed criteria.
What we hear is price is number one, always. And that's consistent among all age groups, but especially among millennial and Gen Z, and our app over indexes with those two. So we know price is king, but it's not just the lowest price. It's also having the best price for a premium economy seat or the best price for a basic economy seat. Part of the reason, if you're not familiar with the history of Hopper, we initially launched the app, and our primary value prop was price prediction. We would predict the future price of your trip, and then we would have an opinion. We'd say, you should book this, or you should not book this. You should wait for a better price to materialize. We'll tell you when that does. And part of the reason we did that is it's not always the absolute lowest price. It's the best price for what I'm looking for. Maybe a direct flight, that's not a low-cost carrier or is. So price is absolutely the most important, but there are other preferences as well. We had great success with something. Its fancy name is called algorithmic merchandising, but the easiest way to describe it is recommended sort on flights. And we, created this big model that looked at a combination of price and then all of the amenities that were offered, everything from Wi-Fi to cabin class, and then used a Bayesian model to understand the incremental value each of those amenities or ancillaries added for consumers who actually booked. And that's how we created our recommended sort. And sometimes the cheapest flight is also the best flight, the best combination of price and quality. Sometimes it's not. And we see similar, interest from users in booking both the cheapest and that most recommended flight. So there's a range of preferences out there. I think what's most important is knowing that table stakes is having the lowest price. And then next up is have the range of supply and quality that people are looking for so they can make those decisions the same way they're making decisions about ancillaries. What do I want? What am I willing to pay for?
Very timely. We have a slide on ancillaries. I guess more, so thanks for that segue, Haley, into that. The point really here that we wanted to look at was more, so Cartroller and the IdeaWorks company recently published their annual ancillary revenue report, which looks at a number of airlines. There's about 65, I think, that participate or that they're able to get data for. And they publish what airlines are publishing in terms of their ancillary revenues. I think what was interesting, their headline, and again, when you dip beneath the headlines, there's always a different set of things going on. But key headlines there is, yes, ancillary revenues have increased pretty significantly between 2021 and 2022, partly because people were returning to travel, but not to the same extent that overall revenues were growing. So interesting comment there. And then the sort of second thing that we thought was interesting was, and this is partly skewed by loyalty revenues from credit cards associated with airline loyalty programs. But the differential between the average ancillary revenues per passenger for North American airlines versus the rest of the world, basically in a sort of descending order, is really interesting. And I think there's a whole piece there, probably worthy maybe of another webinar, maybe of a piece of content, just about understanding, what opportunity is there for carriers elsewhere to really monetize ancillaries in a different way, or sort of pursue profitability in sort of non-traditional manners.
Yeah, I said this morning, Deirdre, and I keep coming back to the airline industry has to get away from talking about passenger yield and talk about yield per seat, because it's the combination of what the fare is and the ancillary revenues, and the successful airlines are those that are going to get the most revenue per seat over time. I think Ryanair are a great example, and Jet2 are another one. They really don't care a flying whatever as to what the airfare was. The most important thing is they've got you captured and predisposed to spend more at various times in your booking journey, from fast track security, excess or baggage allowance, full stop, or catering, whatever it happens to be, or lounge access. And that's really, I think, where the market is going. And that's before you get to the fintech revenues that people will generate in the coming years. It's the seat is just an opportunity for someone to sit there and be bombarded with messages about buying other products that they didn't realize they needed.
It's an enabler.
It's an enabler in every sense of the word. And Mark Morris has just asked a question. Hi, Mark. I need to talk to you pretty quickly, by the way. But is there a difference between full service carriers and low cost carriers? Yeah, I think inevitably there is. We see more revenues coming from, the low cost guys in most markets. In the US, as you saw from those numbers, the revenues are very strong. But Haley, I think that's driven as much by their credit cards and their affinity programs as it is by fast track security, isn't it, and things like that.
Mm-hmm. Yeah, there are a range of places and ways that travelers are now securing their travel, buying ancillaries. There's been a lot of diversification there in the US market. So there's kind of something for everyone in terms of what they want to buy. And we're definitely seeing revenue come in from much more diversified places, which is not necessarily, a bad thing. A diversified market is typically a stronger market. So as long as the consumer is still winning, I think, it makes sense that we'll continue to see these ancillary revenues grow.
How interesting. I think that's a really insightful way to look at it. Unfortunately, we're out of time. I feel like we could have carried on this discussion, and there are some slides in our deck that we just didn't get to. So those of you who have been avidly listening and waiting for some of that conversation, then please dig into the slide deck and the recording that will be coming your way later today. Thank you so much, Hayley, for joining us and for sharing your insights and thoughts with us. It's been really interesting. And John, as ever, thank you for
Pleasure.
For your unique take on the industry and how things are unfolding. We'll be back in December with our next webinar. And we look forward to seeing as many of you again on an upcoming webinar. Thanks again, everybody, for joining us, and thanks, Hayley and John.
Thank you. Thanks. Bye.
Thanks. Bye.